So listen, guys, we only take sponsors for the podcast that we at Green and Sklar's actually use ourselves, all right? So the people that I talk about, the people that I allow to put their stuff on our site, this is the stuff that we use. So for instance, how is it that we get through to the IRS in under 3 minutes? I mean, we have too many cases. I cannot have my staff on hold for hours on end trying to get through. We use Call ENQ. They guarantee you will get in under 3 minutes. I can assure you, usually it is under a minute. You call up, you will get right through. And I'm not joking, when we sat after using it for about 2 months and figured out we were going to cut somewhere around $50,000 to $60,000 of billable time off simply by using Call ENQ. And remember, because we do so much of this as a flat fee, that is money and time that falls right to the bottom line. All right, we've arranged with Call ENQ a trial for all of you, 200 minutes for $19.97. Go check it out. I'm telling you, it will literally change the way you interact with the IRS, and you will actually boost your bottom line. How do we manage our resolution practice? Tax Help software. All right, Tax Help software. It does a lot of things. One is this is how we get our transcripts, right? So we get all of the transcripts, we get that beautiful report it puts together, wage and earning, we get it all in one fell swoop. This is how we do our 433s and our offers and compromise, right? All of our forms get filled out, it applies all the standards, does all the attached schedules, everything. But the biggest thing about Tax Help software you may not realize is that because of intelligent ordering that runs every night while we're at home doing whatever, in the morning, we are alerted to everything that changes on our clients' transcripts. For instance, this morning, I actually know one of my clients' offers have been accepted. I haven't even gotten the letter yet. The client hasn't gotten the letter yet, but it showed up on the transcript. A week ago, I told the client they're getting audited. Why? It was flagged in the transcript. All right. Tax Help software will become the cornerstone of your practice. Okay, we've arranged, again, a free 2-week trial for our members, all right, and a 10% discount. Go check out Tax Help software. I'm telling you, you're going to love it. Lastly, how is it that we manage 21 people? You know, Jeff and I started Green and Sklar's 5.5 years ago with a part-time admin. We're 21 people today. How do we keep track of the receipts and everything else? Because we're constantly on the road, constantly speaking. We have other partners who are constantly traveling. We use Receipt Bank. All right, take a photo. One, that expense gets booked automatically, saving our controller time. Two, the copy of that receipt is now permanently attached in our QuickBooks file. All right, we haven't just this is how you bulletproof your return and how your clients bulletproof the return. This way, if I lose the receipt, I eat it, I burn it, it doesn't matter. It fades, you know, that magnetic ink fades. You have that picture forever. And a picture in this case is worth 1,000 words or possibly a lot more money and heartache. All right, so go check out Receipt Bank, keep building your practices, all right, and enjoy the podcast.
All right, welcome everyone to this week's Tax Rep Network podcast. I'm Eric Green. I think you know that by now. And joining me is a great friend of mine, Jason Freeman. For those of you who do not know Jason, he's a tax attorney who also holds a CPA license. His law firm is in Frisco, Texas. He's also an author, law professor, and trial attorney. Now, Jason, you and I met through the ABA. Right, you're at a much bigger firm. You and I are speaking. You know, just happy to have the opportunity to speak. And then we would we'd give presentations together. Then Jeff and I leave a bigger firm. We go off on our own. Jason, being smarter than we are, watches that and says, "Hey, if those two idiots can do it, so can I." Jason leaves and starts Freeman Law. You now have, I think, 5 other attorneys. Isn't it amazing how that happens?
It is amazing.
Jeff and I, when we started our practice, literally our business plan, one sentence: don't file bankruptcy. That was as much of a business plan as we had, and we're 21 people today. It's crazy. Um, so so again, if you don't know Jason, obviously, if the fact that I have him on, he does a lot in federal and state tax controversies, as well as white collar crimes, financial disputes, both civil and criminal. He also advises and assists clients with tax and regulatory compliance, including domestic and international tax and regulatory reporting requirements. And Jason, so some of the stuff you've done recently, again, for the audience, I think really cool, right? You served as trial counsel in a criminal criminal tax evasion and conspiracy jury trial in the Federal District Court for the United States Virgin Islands. That's one hell of a way to get there, right? As well
One
as
of the perks of a tax practice, those pesky tax credits down in the various island jurisdictions.
but you have clients that take advantage of them. I don't have clients that go to those really cool places. I have clients in like upstate New York.
You know, it does present it presents a pretty interesting trial locale, and it's always interesting when you're down on an island of 40 or 50, 60,000 people, and you're having to things just work differently on island time, as you know, but just having to go out and court juries and check them out and go to the local festivities to really make yourself a part of the population. It's an interesting process, and who would have thought you get those opportunities in a tax law practice?
And that's the interesting thing is people watch the movie The Firm, and how they're down in the Caribbean and whatever. That not only does that happen a lot. Several of our friends have told me they've come wandering into like these big commercial buildings, and like every major law firm is on the placard. They don't really have anyone there full time, but they do have an office there technically, right? Some of the other stuff, you made an oral argument before the United States Court of Appeals for the Third Circuit. That's cool, all right? But if you're listening, Jason's also my go-to guy. When I just want to bitch about running my own firm, but also when these little sticky community property issues come up. Given that I practice in mostly separate property states, Mass, Connecticut, New York, and I have cases around the country, but every now and then there are these sort of outlier areas that have these community property laws, and they change everything, right? And Jason, I know you have a life, so I'm sure you're not listening to the podcast. But if you had, for like the last year, I've been beating the drum, and what that message has been is the following: you got to think before you just knee-jerk file joint, right? I mean, the IRS has told us 7 million non-filers, they're going after them. Okay. So these people are starting to come in, right? And accountants are, getting hit with, hey, prep, 3 years, 5 years, 6 years of returns. I've been telling everyone, put the brakes on, and unless the client's going to just stroke a check and pay it, you really need to think through the collection alternative before you file. Do you want to get the state out ahead of the feds, right? I mean, we have an income tax in Connecticut. There's an advantage to getting Connecticut out in front and utilizing that Connecticut installment agreement, as leverage with your federal offer. Or the idea of, hey, married filing separate to keep the other spouse and their half of the equity in the house, their IRA, all of their assets out of it. But then again, there are these community property issues, and I'll get bombarded with emails saying, hey, Eric, I'm in California, I'm in Texas, I'm in Louisiana. How do the community property laws impact this? The truth is, I don't really know. So, Jason, welcome to the program. And I'm glad you're here to enlighten all of us on how this stuff works.
Yeah, well, thanks, Eric. And by the way, I do listen to the podcast, and I think you've put together some great material. It's a great resource for tax practitioners out there. So really appreciate all you're doing. For those of us in the ABA world, American Bar Association tax section, and we know what an authority you are in this area, and so it's great to see you reaching out and capturing so many others practicing in this area. So appreciate it. But yeah, this is community property is a unique concept, I guess, and unfortunately, for those listeners that are calling you from California, I'll have to tell you that while there are a handful of states that have community property systems, and while they all basically derive from Spanish law concepts, they're not all at current date. They're not all exactly the same. And so in Texas, we have some kind of unique concepts that may change the answer that would apply if we were under California community property law system.
So,
but to your yeah,
I was going to say, Jason, first of all, you just touched on a little bit. Can you explain the difference between a community property state and a separate property state?
Right. Well, so effectively, we've got 9 states that are quote unquote community property states. I think that's Texas, Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Washington, and Wisconsin. And there are a couple of states that have elective community property regimes. So in one sense, in a very definitional sense, Eric, I guess you could define it that way. But really the difference lies in the state's respective property law regimes. And so, for those who don't understand what community property is, it's a form of co-ownership of property between spouses. And so each spouse effectively owns an undivided 1/2 interest in the community property. So, and this may seem a foreign concept, but title to the property really doesn't matter, does not dictate property ownership. And effectively, there's a presumption that all property on hand is community property, and it's it's up to the spouse to demonstrate, in Texas at least, by clear and convincing evidence that the property is not community property. But
so in essence, it doesn't matter, like you said, title wise, it doesn't matter whose name it's in. It's considered community property, which and by the way, for those people listening, as you and I know, when it comes to the feds, the IRS, they look to state law as far as property rights. What is your property? And that's why this makes such a big deal. Like I'll tell you, Jason, in Connecticut, we have no concept of nominee ownership. So the IRS has learned to not file nominee liens in Connecticut because we've got 3 state cases and now a federal bankruptcy case that have all come out the same way, which is there is no concept of nominee ownership in Connecticut. Therefore, there's no such thing as a nominee lien. It's void. And so the IRS, after taking a beating, has learned to not do that. And so if you're listening, that's what we're talking about. So the IRS, they have their rules, but then they're going to start looking at the various state, the state where the taxpayer is, as far as what their rights to that property, what their rights are in the property.
Yeah, that's exactly right. I mean, effectively, where there's a tax liability, as you mentioned, the IRS has got the ability to attach any property or rights to property outside of a few exceptions that the taxpayer has. And generally, we look to state law to determine what those property interests are. And then from there, federal law really governs the IRS's ability to attach those assets. But, just stepping back, going back to the definition of community property, just clarifying, it's really any property that's acquired during marriage, with the exception of property that's acquired by gift, devise, or bequest or inheritance. which that type of property is considered separate property. But again, it's up to the spouse to demonstrate that.
So, and by the way, I understand, and you've already kind of put a big caveat on all this. There are wrinkles between all of the various states, but to break that down generally, if I have property that's my own, and I then come into the marriage, I then, let's say I own my home, and I now meet somebody and we get married. Is the property that I brought with me first separate, or upon getting married, is that now part of the community property?
So it remains separate property. Property that you bring into the marriage is separate property. So technically, there's an evidentiary issue here, in the sense that we need to be able to demonstrate by clear and convincing evidence that that property was brought into the marriage. Assuming we can satisfy that obligation, then yeah, it's still separate property.
Got it. Now, I own a property, but you know what? I'm going to rent that out. Now, my new spouse and I, we go and buy a nicer house while we're married. And now, let's say for liability, I title it in her name. That would still be community property, right? We've acquired it together during the marriage, regardless of whose name we put the title in.
Correct. So the title doesn't dictate. Now, title might be used to evidence some sort of gift at some point. That, again, recall that a gift is separate property, and so it can be changed in that sense. But title really doesn't control. It's just a factor demonstrating the way that it's actually held or was actually acquired.
Okay. And as you just mentioned, so let's say now we're married, my wife and I are married. I have this property I came into the marriage with, that's separate. We bought something together, even though it's parked in her name. Now that's community property. And let's say she receives an inheritance. Her mom passes away, she receives an inheritance. Would that be separate?
That would be separate property. So
and as well as a gift also would be separate.
Gifts and bequests, inheritances are separate property. So you've got separate property on the initial piece of property. The property acquired during marriage would be community property, and the property acquired by bequest would be separate property.
All right. So
now I guess take that a step further. Let's take your first parcel of property and assume that it generates some rent. And then question is that rent, is that income community property, or does it maintain the same character as the underlying separate property? And this is one of those areas where not all of the community property states have the same answer. But in Texas, and I believe we're in a minority of the community property states in this respect, but in Texas, that income generated from that separate property is itself community property.
So the moment it comes into the marriage as income, it becomes community property. So fascinating. What about, and I don't, and Jason, I apologize. I don't want to play 20 questions with you. Like, let's see if we can stump Jason. No. But you know what, that I did read that somewhere once, that you're right, that I think most community property states, the income maintains the or retains the characteristic of separate community based on the source of it. So the separate property that was a rental, the income coming in would also be separate property. But as you said, Texas, and this is why we were talking about, the states all have their own wrinkles and local flair or flavor, if you will. But in Texas, the moment the income enters the marriage, or comes into the marriage pot, if you will, it becomes community property. Interesting. Now,
Yep.
you obviously do a lot of IRS collection like I do. So when you're doing your financials, your 433s, all of that, whereas before we're always, I'm always telling the clients, hey, joint property, that all comes on the property the tax debtor owes, the assets, they all go on the 433. But the stuff that the non-debtor spouse, assuming we have a non-debtor spouse, that doesn't have to be listed. They don't have the debt. In a community property state, it actually is, it's similar, but it's not about the title. What it's about is separate versus community. Community property would all be listed. Separate property of the non-debtor spouse would not be.
Yeah, and I think if you want to boil this down into principles to understand how and why, it is this way or how it works, you really think about it. It's a question of, in the collection context, what's on the table, what assets are available to satisfy the federal tax liability. So in a community property state, it's the liable spouse's separate property. So all of that is on the table. And then the liable spouse's share of the community property, which again may vary from state to state in some respects. But like in Texas, step back again, we don't only distinguish between separate property and community property, but we also break community property down into a few other conceptual buckets. So one of those is something called sole management community property. The other is joint management community property. So when we go back to this question of, what assets are on the table in Texas, again, it's all of the liable spouses' separate property, 100% of the liable spouses' sole management community property, 100% of the joint management community property, and 50% of the non-liable spouses' sole management community property. So that basically means the IRS could even attach the non-liable spouse's wages and would have a claim to 50% of those, which is, for many listening, I'm sure, pretty scary.
Wow. Okay, wait a minute. So, right, obviously the separate property of the debtor spouse, we know that's it. Now we have the community property on the table, but of that, the sole managed by the tax debtor, that's in. The joint managed, that's all in, not 50%, all of it.
Right.
And then of the separate that only the non-debtor spouse is managing, 50% of that.
Correct.
Wow.
Scary.
It is. That I did not know. And so the joint household, the joint house, that's all in. Or is it, because it's jointly managed, correct?
Yeah. So when you get down into, I think your question is kind of getting at, how do you distinguish between sole management and joint management property?
Right.
The Texas Family Code actually has a statutory definition, and as far as sole management control property goes, it's basically the community property that the spouse would have had or owned if single. So you can think of your personal earnings, revenue from separate property, recoveries from personal injuries. These types of things are treated as the sole management property. and effectively everything else is joint management.
Now, is that though this management concept of breaking down even the community property, is that only a Texas thing?
That's a Texas specific. It's a Texas specific thing.
So now, if you were to go to, let's say, Louisiana or California or Idaho or one of the others, when it comes to the community property, again, separate property of the debtor's spouse, we know that's all in. Of the community property, is it usually just 50%?
It usually, if you didn't have these concepts, it would generally be 50% on the table. And the idea there is, under the property law system, that spouse has a property interest in 50% of the community property. Texas system gets a little more complex because it's set up to actually provide creditors, not the IRS specifically, but creditors in general, with the ability to come after the spouse's obviously separate property, but also in most instances their sole management community property and the joint management community property. It actually purports to protect against the non-liable spouse's sole management community property. The problem here is there's really two things going on here. The problem is that case law and the Supreme Court has held that exemptions of that nature, like with respect to the non-liable spouse's sole management property, they are not binding against the IRS. So the IRS pierces that particular protection. And then again, Texas law puts 100% of the joint management community property on the table. So that's how you get this kind of unique system from Texas.
Yeah, don't, if you're a tax debtor, don't move to Texas. Now, on that note, by the way, the non-filer, right? And that's what I'm just thinking, because I don't know how, I can't think of another scenario this would happen. Is there an advantage to moving property to a separate property state before you file?
To actually moving the property?
Yeah, no, of course, if it's real estate, that's easier said than done. But
defies the law of physics.
Yeah, right. But if
you property?
But if you had collectibles, if you had assets that could be moved, or even financial investments, if the spouse were to up and move domicile to a separate property state, like they came to Connecticut, why it'd be beyond me, but they come to Connecticut, they're like the apple picking, whatever. And then they file. I mean, I'm just trying to think through. Is there listen, Jason, I'm sure you've gotten this too. I've gotten a whole bunch of people that have said, would it be advantageous to me if, while the IRS is investigating me, I up and left and went to Israel? And I'm like, one, I cannot counsel you to become a flea justice. And by the way, they're stopping people at the border anyway. But that aside, is there an advantage? Is there some sort of planning that can be done at that level?
So, yeah, it is a common or recurring question, and one that I think's generally asked in very good faith, and it's a natural question to rise. Generally, the answer is no. As far as a pure theoretical answer to that goes, the community nature of the interest in property is determined at acquisition of the property. So subsequently moving the property doesn't change the community property character of the property. Now, that said, is it possible that there are some practical advantages to that, right? Let's just assume the scenario that it's not done for the purpose of evading the collection of tax, right? We're assuming away the criminal aspects of what could motivate some taxpayers to take those steps. Let's just assume the situation exists. Is there a practical advantage? I can think of some in the sense that the IRS might be the IRS agent in a common law state, in a non-community property state, might be less likely to look at community property implications where collection actions arise in that separate property state.
Well,
I mean, as a practical matter,
Yeah.
you're likely to get a local revenue officer who's not going to be versed in community property issues.
Oh yeah, if non-filers walk into your office and they're renting an apartment, but one of them has some significant investments, I could see with, what, if we're going to file, let's move to New York. Let's file as New York residents. Well, you know what? Here's the problem with it. As I sit here dreaming this crap up, what are you going to do about the state returns? You're not going to want to file back New York returns when you weren't there. There may still be some giveaways that may, but if you were to come into the IRS, who normally does not check to see if you filed your state returns, and you file your returns with a New York address. Anyway, you know what? It's interesting in theory, but probably impractical.
You go down that rabbit hole. Another distinction with Texas, we don't have an income tax.
Right.
So as an individual, there is not an individual income tax return to be filed.
You could theoretically head to a separate property state, file 6 years or however many years of missing returns that you have if it's less than 6, and use your new address and see if the IRS ever smartens up to it. But theoretically, that property would still be, if it was community property when you left Texas or California or wherever, it would still be community property for collection purposes in Connecticut.
That's right. Yeah, the properties, the nature of the property does not change as a result of moving.
So listen, for the folks listening to this, is there any strategy if you have clients in a community property state? Like I had mentioned the idea of married filing separate, whatever. Are there some planning things that you can do in a community property state, either before you file the returns or when you're dealing with collection?
I mean, there certainly are. One of the things that you find yourself having to do a lot in these situations is counseling against making an already bad situation worse. So there are a lot of there's a lot of work that goes into avoiding, helping clients avoid transferee liability and fraudulent conveyance liability, and making what might be a civil problem that, while serious, deals with money, preventing that from becoming a criminal problem. So there are boundaries around, certainly what can be done and done legally, but there are a number of tools. And one of the things that comes to mind with your question is, in Texas, a marital property agreement. So we actually, by Constitution, have an ability to take taxpayers or spouses out of a community property system, or to divvy up which property is actually community and which is not. Certainly, your safest territory on that is on the front end, when, and this is a common situation where we have, two people who are going to get married, want to get married. One of them comes into the marriage with a significant tax liability, And the idea is, well, what can we do to protect both of you, to protect the marital unit? And one way to do that is basically a separate property agreement where we're ensuring that the spouse that doesn't have that liability, that their assets remain protected from that, from collection on the other spouse's liability.
And again, as long as you can plan it in advance, it's it works well. I mean, we've had this where we have they're not married, but they're living together, and he's giving her cash every month to put toward the expenses. Well, here this is a more minor version of it, but begin paying by check, so we can prove that you do that, and you can at least get credit for some of those expenses. Again, in your situation, if one has the debt coming in, so you know about it, but it's not the kind of thing you probably can do on the fly after they've been married a while.
So it can be done after the fact, and it's not just a prenuptial. There's a concept of a postnuptial agreement that can be done basically to mitigate the damage. To me, with what I see, this is the area where you've got to exercise more caution and certainly be careful in how it's implemented. But it's an area where, look, like a great example is we want to protect the non-liable spouse's wages going forward, right? We don't want those to be community property that's on the table. Well, let's partition those off, so to speak, and let's put that in the separate property agreement, and we'll treat those as separate property. And that's good for everybody. And that can be done, certainly done after the fact.
Very cool. Well, listen, a couple things. First of all, thank you for coming on and explaining this. I learned a whole bunch of stuff tonight. And mostly, if nothing else, how little I know about community property. But before we, and if you're listening to this, you may have noticed, Jason every now and then is a little broken up. We are having a nor'easter tonight, a rainstorm, which I can hear kind of impacting the recording a little bit. But Jason, before I let you go, so what else is going on with Freeman Law? We know you're down in the Virgin Islands, fighting criminal cases. You've been in front of the Third Circuit. What have you got going on?
Tell you what, Eric, it's an exciting time up here. We're down in the Dallas-Fort Worth area. I'm in a suburb just north of Dallas and Frisco, and it's a booming economy down here. Things are growing. We're growing. We are in the process of purchasing a new building that we'll be moving the firm into, and so it's an exciting time to be practicing.
Yeah, no, and also, if you're listening, Jason does a lot of posting out on social media. I read some of your cryptocurrency stuff. He is speaking all over the place, which you can certainly follow him. And on that note, Jason, before I ask my last question, how can our listeners get in touch with you?
So my email address is jason@freeman-pllc.com. Name of the firm is Freeman Law, and you can find us online at the same domain name. And my phone number is 214-984-3410.
Yeah, no. What I'll do, Jason, is I'm going to put all that down in the description, so people can, if you want to get a hold of Jason, you can click down there. His email would be there. The link to Freeman Law, and if you need anything, or you want to follow up with Jason, or you think you could use his help in a case, absolutely reach out. He's a terrific resource, even for us as well. All right, so last question, which is not about community property. I talked about how you built your firm so much. We have a lot of tax rep members who are trying to build their firms. What have you learned? What do you think is one of the key things that have allowed you to grow as quickly as you have?
Eric, in a lot of ways, I would say while it has been quick, it doesn't always feel that way. I would say the answer to that is really hard work and keeping your head down. I maintain a very full schedule. We take a very aggressive approach with the IRS and litigation. I think clients and attorneys out there have taken note of that. It's certainly been essential in growing our practice. But I think the key is to get out there, provide world-class service to your clients. Once those clients turn into your main referral sources, there's really no stopping you.
I couldn't agree more. And you hit everything. First and foremost is do excellent work, right? Provide excellent service. But you are out there, and people do take notice. The rest of us are following along, and I've been very duly impressed. And listen, thank you. Keep doing what you're doing. I appreciate you're doing this. I will probably be having you on again in the near future because this has been a lot of fun. And I definitely learned something tonight. So Jason, listen, thank you for taking the time and doing this. And I appreciate your coming on.
My pleasure, Eric. Thanks for having me on. Happy to come back anytime. And thanks for all you're doing.
All right. No, and thank you all for listening, and keep listening in. And, if you have any questions, go ahead, email us, right, at podcast@taxrepllc.com, and talk to you next week.